Welcome to the Pro Ticker Deep Dive. Every few years, that same question starts doing the rounds on trading desks, and right now it's getting pretty loud. Is the mining boom actually coming back? I mean, you see the signs. Australia's miners are right there, center stage. Iron ore, it's holding up okay despite all the China worries. Gold is hovering near record highs, which is amazing. And copper, well, copper is definitely back in the spotlight. It's the metal for electrification, right?
It really is. We're seeing, I think, a critical inflection point, and that's exactly why we're digging into this today. We need to look beyond the sort of day-to-day noise, the rallies, the little spikes, and figure out if this strength we're seeing now is just, another temporary uptick that'll fizzle out, or if this could be the start of something bigger, maybe a genuine new supercycle. So our mission today, really digging into the data, the research, is to give you the executive summary straight up. The whole sector is shifting, fundamentally. After, nearly a decade of being really conservative with spending, the hangover from the last boom, the industry's moving now, moving from just playing defense to strategic expansion. Now, it's not a crazy speculative boom yet, but the groundwork. It's being laid, we think, for a long, disciplined cycle. And it's driven by two key things: real structural demand and much smarter use of capital, not just speculation this time.
Okay, let's unpack that because it does feel like a pretty big shift. What are the macro forces really reshaping things here? It sounds like it's not just simple rising demand anymore. It's more
Complicated.
conflicting pressures, maybe?
Exactly. It's like the global commodity scene is being pulled in two directions at once. Really powerful forces. On one side, you've got the slowdown in traditional demand drivers. We're talking mainly about, Chinese property construction, heavy industry, the stuff that powered the last big cycle. That engine's definitely slowing down.
Okay, the old engine.
But then, pushing against that is this massive new force. And this is the real game changer. It's the energy transition, a once-in-a-century kind of thing. It's not just one project. It's a total overhaul of infrastructure, creating this huge foundational demand everywhere. Think power grids, massive renewable projects, EVs, all the data centers. It's global.
Right, so that structural shift, that must give Australia's resource base a pretty big advantage, doesn't it? But how long can that last? Is it sustainable?
We think it's highly sustainable.
Yeah.
Because this next wave of demand, it's global, it's broad, it's driven by decarbonization goals that aren't going away.
Yeah.
Australia's got these deep reserves, top-tier stuff, iron ore, copper, lithium, gold. That gives it leverage in both the, let's call it, old world infrastructure needs, which are still vital, and the new world green tech that needs all these materials. The demand is much more diversified now.
That brings up a really interesting point for the miners themselves, though. How are they actually balancing this? Keeping the reliable old exports going, the stuff that pays the bills right now, while also committing to these huge long-term supply needs for the energy transition. It feels like they're trying to run two different businesses at the same time.
They absolutely are. And interestingly, the market seems to be rewarding discipline, not just sheer volume growth this time, which brings us nicely to the core commodities.
Yeah, let's get into those. We've got four key ones to look at. Let's start with the bedrock, the one that funds everything else. Iron ore. Still the old king, right? Despite all the pessimism, the constant talk about China's property market wobbling, steel production, infrastructure spending, they've held up surprisingly well. How does that work?
Yeah, it seems counterintuitive, but you have to look beyond just new apartment blocks. The stability isn't really coming from housing starts. It's coming from Beijing stimulus, which is more strategic now, more incremental. It's focused on fixed assets, manufacturing for export, core infrastructure projects. That keeps demand ticking over, maybe not roaring, but enough to keep prices somewhere near their historical averages. So yeah, it's stabilization, but it's built on careful supply management, not soaring demand.
You mentioned discipline and stabilization there. It suggests the big players aren't just chasing tons like they used to. When you talk about operational excellence, what does that look like day to day?
Oh, it's a total mindset shift. It means cutting costs wherever possible, getting rid of high-cost operations, and really leaning into technology to mine smarter. Think about the huge investments in autonomous trucks, like Rio and Fortescue have rolled out, or using digital models, digital twins, to optimize how they blend ore and process it. They're often focused on maximizing the grade, the quality of the ore they ship, even if it means slightly lower overall volume sometimes. Why? Because the profit margin on high-grade stuff is just better, more reliable. It's all about the margins now, not just throughput.
Okay, but hang on. You make it sound almost comfortable. stable.
Yeah.
Yet the research, the risk sections, they clearly flag China's property slowdown as the #1 threat. Shouldn't we be worried the stability is just, the quiet before things potentially get rough if that property driver really tanks?
That's a fair challenge, and it absolutely is the main risk hanging over the sector, no doubt.
Yeah.
The market seems to have priced in a reasonably soft landing for Chinese demand, but if that property market weakens much more, really aggressively, and the stimulus doesn't plug the gap, then yeah, that stability could evaporate quickly. And you see the majors using this current stability, this cash flow, to de-risk. They're funding their expansion into other things like copper and lithium, basically trying to diversify away from relying too heavily on iron ore, just in case. That itself tells you the risk is real.
Okay, that makes sense. Now, let's pivot to where the real excitement seems to be building. If there's one commodity that defines the next decade, the sources are pretty clear. It's got to be copper, the metal of the future, the absolute lifeblood of electrification. The demand drivers are just huge, aren't they? The whole world is electrifying faster than, well, maybe ever before.
Oh.
Your grid expansion everywhere, data centers popping up, needing incredible amounts of power, which means tons of copper wire and EVs, electric vehicles, multiplying way faster than the supply chain was ready for.
Exactly. And the defining story for copper isn't just demand, it's structural scarcity. This is key. Copper is different. Bringing a major new mine online takes years, often, like over a decade. You've got permitting, development, construction. It's a long haul.
Right.
And the pipeline of new projects looks pretty thin. Why? Well, a few reasons. Grades are falling at existing big mines. It's harder to get permits, especially with tougher ESG standards, even in safe places. And frankly, there just wasn't enough exploration spending over the last 10 years.
So the scarcity is real.
The scarcity is very real. We're looking at projections showing a pretty significant global supply gap opening up probably in the next 5 years or so. This isn't just market speculation, a short-term blip. It feels like a structural story driven by that irreversible energy transition push.
Yeah.
And Australia, with its established infrastructure, good geology, it's really well positioned to be a key supplier when that copper crunch eventually hits.
Okay, moving from that intense pressure on copper, let's talk gold. While everyone's focused on tech and electrification, gold's just been quietly doing its thing. Really well, actually. What's fascinating is how it's performed over the last, say, 18 months. Pushing towards record highs, but almost stealthily. What's behind that?
Yeah, it's interesting. Gold seems to be acting less like just a simple inflation hedge these days and more like maybe a geopolitical shock absorber. The main things pushing it up seem to be, well, two things, really. First, just persistent rising geopolitical tension globally that creates that classic flight to quality demand. And second, critically, central banks around the world have been buying gold aggressively, restocking their reserves. That's a big, long-term institutional buyer stepping in.
And for the Australian miners, that creates this powerful tailwind because of the currency, right? Can you just break down simply how that works? The strong global gold price plus a weaker Aussie dollar equals bigger profits.
Sure, it's actually a pretty straightforward mechanism, but yeah, incredibly powerful for their profit margins. Australian gold companies pay most of their costs, wages, fuel, local contractors in Australian dollars, AUD.
Right.
But gold itself is priced and sold internationally in US dollars, USD. So when the global gold price in USD is high and the Aussie dollar is relatively weak against the US dollar, when they convert those USD revenues back into AUD, they get more bang for their buck. Costs stay relatively stable locally, but the revenue gets amplified by that favorable exchange rate. It basically turns gold into a kind of growth asset in disguise for the local producers. Leads to really healthy margins, allows them to pay good dividends too.
Right, makes sense. Okay, shifting gears again from the relative safety of gold to probably the most volatile area we've looked at, critical minerals, specifically lithium. We all saw that frenzy in 2022, early 2023. Prices went stratospheric, everyone piled in, and then bang, a really sharp correction.
Oh yeah, it was definitely a party, wasn't it?
Yeah.
And now we're left with the operators who actually know how to run a business, the ones cleaning up the mess, so to speak. But the result of that price crash, harsh as it was, is probably a healthy thing for the long run. We're left with a much more rational market. It's leaner, definitely more disciplined, and crucially, it's still fundamentally aligned with that undeniable long-term growth trend for electric vehicles. The demand story hasn't gone away.
So the market basically shook out the weaker, higher-cost players. Who are the winners now, then? And why is securing these offtake partners suddenly so critical for them?
Well, success now is partly about managing costs really tightly, yes. But the big differentiator is stability and integration into the supply chain. An offtake partner that's usually a big global end user, like a battery maker or a car company, they agree to buy a set amount of your lithium or whatever mineral over a long time, often 5, maybe 10 years. That commitment is absolutely vital. It's often what secures the financing needed to actually build the mine or processing plant in the first place. It locks in reliable demand, predictable revenue. So the winners now, they tend to be the ones with lower cost, top quality assets who can manage the complexities of the supply chain and, crucially, lock in these long-term deals. A lot of the more speculative projects, the ones relying solely on those crazy spot prices, they struggled or failed when prices fell. There's less hype around now, definitely, but probably more genuine, solid opportunity for the serious players.
Okay, so let's try and pull all these threads together. What does this whole picture mean for the outlook? We're seeing these incredible structural opportunities, but as you said, some pretty significant risks too. Let's start with the biggest plus. What's the most compelling advantage here that people should really focus on?
For me, it has to be that long-term supply gap. Copper, nickel, some of those battery metals,
Yep.
driven by the energy transition. That seems like the single biggest structural opportunity in this whole sector for the next 5–10 years, wouldn't you agree? Absolutely. That's the core long-term thesis. And we can layer on top of that maybe 3 other tangible advantages, especially for Australian miners. First, Australia still has that crucial export leverage. Its location, close to Asia's big industrial centers, that matters for supply chains. Shorter shipping, established relationships. Second, as we just discussed with gold, that currency support. A relatively weaker Aussie dollar is still a tailwind, boosting profits for exporters across the board.
Right.
And third, don't underestimate the efficiency gains. Miners are pouring money into tech. AI for finding deposits faster. Autonomous drills for getting to deeper reserves safely. This digital mining stuff, it's really boosting productivity, helping them fight back against some of that cost inflation we're seeing domestically.
Yeah, speaking of costs, let's flip to the risks because they're definitely there and need to be considered. What's the biggest global threat right now that could derail this whole positive story?
We have to come back to China, specifically that structural slowdown. That remains the dominant global risk factor. If the property sector weakens much more, much faster than expected, if the government stimulus isn't enough or dries up, then iron ore faces real pressure again. And since iron ore still generates so much of the revenue, that could disrupt the cash flow needed for investing in those strategic future-facing metals. That's all interconnected.
And the domestic picture has challenges too, right? Especially over in WA where so much mining happens. We hear about cost inflation, labor shortages, driving up wages, transport bottlenecks.
Yeah, absolutely. Those are very real operational headaches. Cost inflation is sticky, finding skilled labor is tough, and the rail and port infrastructure is often running at capacity. And then you've got broader risks too. Things like tougher environmental standards, longer delays, getting permits for new projects. That slows everything down, makes planning harder, and, just general commodity volatility. A sudden jump in the US dollar or tighter money globally, that can hit metal prices in the short term, even if the long-term demand story is solid.
So how do you frame the outlook then, balancing opportunity and risk?
I think the balance favors patience right now. The really big structural opportunity. That probably plays out more over the next 3 to 5 years, maybe longer, as those supply gaps really start to bite and the new projects slowly come online. It's not necessarily about the next quarter's results.
Which brings us neatly to the technicals. What are the charts telling us about how investors are actually behaving? Are we seeing that kind of manic buying we saw in past booms?
It's actually surprisingly calm. If you look at the ASX Metals and Mining Index, it's basically been moving sideways for several months, consolidating in a healthy range. It's not falling apart, but it's not rocketing higher either. It feels like it's building energy. The technical picture is sort of neutral to bullish, and that suggests quiet accumulation. Bigger players, maybe institutions, slowly buying in, building positions for the long term, rather than that frenzy, that euphoria you see Euro market top.
Yeah, and you can see examples of that quiet buying, can't you? The big diversified miners are showing steady momentum, but also some of the mid-tier guys, the specialists in copper or lithium, they're seeing volumes pick up, suggests people are starting to position early. So the final takeaway seems pretty clear then. This time around, it doesn't feel like chasing quick headlines or pure speculation. It feels more like building for a longer game. Mining that's cleaner, uses more tech, is much more selective, and it's built on real structural demand drivers. Maybe this is the calm before a potential multi-year expansion, an expansion driven by decarbonization, not just the usual economic cycle.
I think that's a good way to put it. The core fundamentals, you look at the tight supply forecasts for key metals, the undeniable needs of the energy transition, plus that newfound discipline from the miners themselves, They all seem to be quietly lining up. So for listeners, those who can maybe look past the short-term market noise, ignore the daily price swings, and focus on that 3 to 5 year picture, they might find themselves positioned near the start of something quite significant. The boom, as we knew it from the past. Maybe not exactly back, but something is definitely awakening, and it feels like it could be a much more sustainable version this time.
Really fascinating stuff. Thank you for joining us for this crucial deep dive into what's really happening beneath the surface in global commodities.
A pleasure. Thanks for having me.
See you all in the next Pro Ticker Deep Dive.